Mehra joins us. Let's take our conversation forward. Devina, fantastic to have you back. Thank you for joining us. You're wearing green. We should have called you before.
Good morning.
Uh, it's getting bad. Will it get worse before it gets better? That's the question.
So let me just step back a bit because when you are right in the midst of things like this, there's a lot of noise around you when you're trying to predict short-term movements. So I mean, just if you look at what has happened year to date globally and in India, you see equity markets around the world have done very poorly. Of course, so there's only a handful of countries which are even in the green year to date, and which is primarily the commodity plays. So it is the Saudi Arabia, UAE, a handful of South American countries like Colombia and Brazil and Chile and so on. So it's just like about 5-7 countries which are in the positive. And just like how not to get just caught up in recent events. If you go back last year, for example, same time last year, everybody thought Nasdaq was a no-brainer, that you couldn't go wrong buying Nasdaq, which is why you had all these Nasdaq ETFs and funds coming in. You had people opening Robinhood accounts or accounts with other brokers. Now Nasdaq this year has been the absolute bottom performer for the year. For the year to date, it is almost like out of 40 indices, it is like number 38 or something. So now it looks like suddenly that the risks are very high there. The risks are very high in India. Risks are very high everywhere else. But as I said, if you step back, now we did this exercise that you have this thing in your mind that if you remain in Indian equity markets in the long term, you will compound at an average of 15% plus, because that's been the long-term average. And we said, like, what if you miss out on a few big up move days? So said, like, in 40 years when Sensex has been around, your 100 rupees has compounded to 44,000 rupees. Suppose you miss out on 10 good days, which is like what, one day in 4 years. And suddenly your return from that 44,000 goes down to 15,000. So that's like a 2/3 return gone just by missing out on 10 days. You miss out on 30 days, which is less than 1 day a year, and you're down to less than 4,000 rupees, 90% of your gains gone. So, I mean, we often think of risk in terms of the risk of being in the market. There is also a risk of being out of the market. And the other thing which we found was both, and in S&P, the numbers are even starker. You're in 100 years, if you miss out on 100 good days, instead of compounding from $100 to $21,000, you're actually down to $40. So, so that's what you're talking about. So, and the other thing which we found was that if you miss out on these updates, obviously you lose. But the other incredible part was that most of these updates come in the middle of a crisis or after a crash. They are rarely part of a bull run. In India, the only time we found them as being part of a bull run was in the Harshad Mehta scam time, which was a rigged market. Otherwise, it's never happened that in a bull run you get those 8% or 10% days. So it always comes after a crash or in the middle of a crisis. So, I mean, now I think the risks are more in sitting out rather than being in the market. So, said, like, if you step back, not talk about 1 day, 1 week, even 1 month, if you're looking at equity as a long-term investment in your asset allocation pie, this is now the time to be back in.
Such a solid advice, Devina. You made a day by putting a lot of calm at a time when there is this entire chatter about what could go wrong and nothing could go right. So I'm with you, and this has been a channel view that money is made or returns are generated in equity market not by buying or selling but by spending time in the market. So we are perfectly aligning with the big picture. Is the question is that while it is important to stay invested in this market, in the short term, should one also be mentally prepared that look, the fall is not over yet, which means that you could buckle for another 5-10% fall?
That could certainly happen. I mean, see, none of these big up days are predictable, that you can't say that they're going to come next week or next month. But as I said, if whatever you want to invest incrementally in equity or something that you've taken out, Invest it not just in one go, maybe over 2-3 months, but invest it. So, I mean, there's always, and always in equity markets, obviously the downside risk is there, which is why you should have a long-term perspective, at least 3 years plus, I would say. Now, if you have a 6-month perspective, you don't know whether the markets will be up or down. That's always the case. I was telling someone that a friend of mine just sold some ancestral property and he was saying maybe in 6 months or 12 months I'll buy another property. So where should I park the money? Should I give it to you to manage? I said, you put it in a bank FD because that's the only place where you know for sure that after 6 months you will get at least the principal plus back. Right now, even in fixed income mutual funds, you're not sure of that, or any fixed income product also you're not sure of that. So depends on what your time frame is, what your objective is. And as I said, always look at it on an asset allocation basis. So not all your money should be in one asset or the other. It should be spread out, and it should be spread out geographically also outside India as well. So that's always been my advice.
But Devina, for the Indian viewers watching us right now and equity lovers, what is the advice? Because you mentioned that, don't be afraid of the fall. Maybe the time has come to at least start nibbling in. What are the pockets which are looking interesting? And do you buy more of the same that you did in the previous peak? Or do you think there will be newer leaders which will emerge after the recent fall?
Okay, so again, take a long-term perspective. It is not obviously always the same stocks or sectors that continue to do well. So while the Sensex we are saying is given this 15% compounding, if you look at the original Sensex list and you had remained invested there, you would not have made that, because that has all these Hindustan Motors and Scindia steamships and the paper and the textiles and so on. So now you have a completely different set of companies, which some of which like IT didn't even exist then. So, and also, I mean, if you look at shorter term thing, like even in 2021, it was like a rising tide lifting everything, some more, some less, but everything went up. But now that is not the market. So you have to be a little more selective. Currently, I mean, we really look at our portfolios every 3 months from a zero-based basis. Though usually, I mean, 85-90% of the stocks remain as what they were in the previous quarter, but we do look at that. Right now, I think our overweight sectors would be capital goods, textiles, parts of chemicals, very selectively, autos. We also had energy, but that's not looking that great anymore. Telecom, and IT also, we still remain somewhat overweight, even though, year to date, that has not been a great performer. But given, as you know, my bet has been that this year, rupee depreciation will be significant, which we have now started to see. I mean, I've been saying it for over 6 months now. So the export-oriented sectors continue to be in our focus list.
Devina, the other thing is what seems to have shaken up the world is interest rates and inflation. A, have the markets priced in the worst? And B, I mean, how critical are interest rates and inflation in the current scheme of things?
Yeah, suddenly they've become very, very center stage. I mean, in India or other emerging markets, inflation always periodically, of course, rears its head. But for the world, inflation has come back after decades. I mean, literally, for the first time, if not in the living memory of people, certainly in the career memory of people who are in the markets, because like in the US, it is at a 40-year high, in Germany at a 48-year high, in Spain also at a 40-year high. Most countries in the world, especially in the Western world, it is like between 20 to 30-year high. Even in India, the wholesale price index for financial year 21-22 was over 13%, which is a 3-decade high. So it is like off the charts. And so therefore, something which people had not factored in. And interest rates, why they matter to the markets, I mean, if I put it very, very simply, any security that you buy, whether it is a bond or a share, is valued as a discounted value of future cash flows. So as interest rates go up, the discount rate goes up, and therefore the value of those cash flows, especially cash flows which are out further into the future, reduces. So which is why you say growth doesn't do well, which is all these tech companies or even not really tech companies, but which call themselves tech companies, where the cash flows were out in the future, have seen the biggest hit, because as interest rates go up, their value reduces the most dramatically compared to companies which have cash flows and profits today. So that will remain an overhang. But I mean, it's a question of how much equity markets have already priced in. As I said, NASDAQ is about the worst performing index in the world today. So interest rates, yes, I mean, central banks will continue to raise, no doubt about it. The Fed's remarks are quite clear that they have to bring inflation under control. And if you look historically, inflation has almost never come under control. I'm talking the US, without real rates being positive. Real rates being positive means that interest rates are higher than the inflation rate. Currently, inflation is 8.6%. Rates after this hike is 1.75%. So I'm not saying that it will go up to 10%, but there is still a lot of room for interest rates to go up. India has been somewhat late, in my opinion, in raising interest rates. Now, of course, RBI has done 2 rounds, but still it will take more to align interest rates to where they should be. So definitely, that is going to be an overhang on markets.
Good morning, Devina. This is Nantara also joining in on the conversation. I remember you once saying that banks are never a safe bet and you don't like banks. But just given their underperformance, and I get the fact, it was being, we were waiting for the balance sheet cleanup. Now that that has happened, the fact that it can be one way to fortify a portfolio against inflation, one way to play the capex war also that we're seeing between conglomerates. Are you willing to change your mind on banks?
As I have said, banks, we had, considering they're such a big part of the index, we've had negligible weightage through 2020 and 2021, which of course would prove to be a very good bet, because in 2020, banks were the only sector in the negative, and 2021, while it did go up, it went up less than half what the market went up. So since then, we have increased our weightage. It would still be somewhat underweight. And there's some positive to banks when interest rates go up, in the sense that your loans get repriced immediately, whereas the deposits get repriced only on renewal. So for some time, at least on the lending side, the margins go up. Though, I mean, on the bond side, there is a negative impact. And for Indian banks, the bond side is also significant. But if there is pain in the economy, again, I mean, whether that would pressure the credit side, that remains to be seen. So banks are definitely not, I mean, as I said, they're better than where they were, but they're definitely not something that we love and we want to be greatly overweight in. And the other thing with banks is that always the number of negative surprises is higher than the number of positive surprises. And as an outsider, it is very difficult to see it coming. So that also remains an overhang for me on the banking sector. So I'm never that comfortable buying banks, because the certainty is far lower, and that for a very highly leveraged sector. So 5% NPA, for instance, is a very large percentage of the shareholder capital of banks. Unlike, so, and that's never something that is, you can't, that can't happen. So I'm always wary of banks, but being such a large part of the market, you can't steer clear of them entirely.
So Devina, can you share with our viewers that when you've increased your weightage with banks, how you've done it, which were the stocks that you did select, and we've been doing this banks versus IT comparison. You've been overweight on IT. Are you still?
Yes, it still be somewhat overweight, not hugely. I mean, in any case, see, we don't take very, very skewed sector bets. That we are always quite well diversified in terms of sectors and companies. And I don't think, in fundamental terms, you can really compare banks and IT companies. IT companies, the reason why in the first place, we've liked them since 2020. So they've made us a lot of money, not this year, but they have. And there it was that at that time, if you remember, FMCG was the flavor of the day. And our bet was that just as FMCG, we say that earnings are reasonably predictable, they're reasonably predictable in IT as well. Returns, while not as high as FMCG, are still pretty good. And the valuation gap was huge. So some of that valuation gap got filled in 2020 and 2021. And plus it's a dollar hedge, which is important at this point, and which is very different from banks. I mean, I said that in the banks, the predictability level is rather low, and negative surprises come with periodicity in that there. So it's very different from IT. So I don't know how to compare these two very, very different industries. There are a few parallels that I can think of.
The setup is perhaps very easy, Devina, in terms of what central bankers want to do with inflation. If inflation comes down, which it will, then it will start having impact on commodity prices. Crude already has started declining. Should one avoid commodities at all, whether it is soft or hard, whether it is industrial or core commodities?
See, metals have already given up all their gains for the year. So they went up and then they came down. So, metals, you have that has already happened. So other than energy, most at least hard commodities have given up their gains. Energy, we think, will take a pause, but is it going to come down dramatically on a sustained basis? To take a pause, it might come down a bit, but I don't think it will. I think it will still remain on a fairly high plateau, given the supply demand dynamics. So that is not something that you can say that now it is over and now commodities will come back down. Agri commodities, there is actually a physical supply constraint, especially after the war. So there also, I don't see it cooling off immediately. So that part will, if not go up further, all these things will still remain at a high plateau. On metals, a lot of it also is dependent on China demand, how their lockdown, open up, all of that keeps that. So there's a lot of news flow which drives that. So that needs to be monitored more closely.
Okay. Devina, really appreciate your time and thank you for joining us, and thank you for your valuable inputs.